Alphabet is on the verge of turning into a $10 trillion company. According to my DCF analysis, even with a modest multiple of 20 times earnings, Google shows massive upside potential in the coming 10 years. They are already dominant in almost everything internet-related, and now they're taking the next step into artificial intelligence, potentially supercharging their company. Just listen to what the CEO Sundar Pichai had to say about this potential.
There's an AI. It's based on our multimodal model, so it can see what you see.
Yeah.
You can talk, you can ask it to reason about the world. And remember, it's just at the early stages, and these things are going to progress pretty fast. Next few years, you'll clearly have AI, which will give you all semblance of being conscious, and you may not be able to differentiate.
This transition will impact every part of the business and transform Google from the bottom up. But what's to say Google doesn't deserve an even higher premium multiple of 30 or even 40x earnings, blasting past $10 trillion. So let's take a look and see how these new AI investments could shape their valuation. In this video, we'll be answering 3 important questions. Do Alphabet's price ratios look cheap right now? What are analysts' projected price targets? And most importantly, what is the true fair value using my own DCF model? We're starting the valuation by looking at the stock's current price multiples. A price multiple simply divides the company's share price by a financial metric like earnings to see if the stock is fairly valued. For reference, broad market averages are usually around 1.5 to 2 times sales, 15 to 25 times earnings, and 2 to 3 times book value. Keep those benchmarks in mind, because in the upcoming slides, we'll see exactly where this stock stands. The PE ratio compares a company's share price to its earnings per share. Alphabet's current PE is about 21. That's 14% below its historical average and 37% below the industry average of 34. Over the past 5 years, we can see from the chart that its PE has generally trended in the low to mid-20s range recently, down from the highs above 30 in 2021. This suggests the stock is trading at a clear discount, both to history and to peers. The price-to-sales ratio compares a company's market cap to its revenue. Alphabet's current PS is 6.62, slightly above its historical average by about 3%, but still almost 12% below the industry's 7.5. Over the last 5 years, it has been as high as 7.3 in 2024 and as low as 4.98 in 2022. For comparison, the S&P 500's aggregate PS is around 2.8 today. So right now, valuation is sitting in the upper middle of its recent range, but still cheaper than the sector. By the way, you can check out my previous video on Alphabet's financials, along with an in-depth moat analysis by clicking the link in the corner. The PB ratio compares market value to book value. Alphabet's stands at 6.77, almost exactly in line with its historical average, down just 1% and 15% lower than the industry's 8. Over the last 5 years, we've seen PB drift between 5.49 and 7.82. So today's value is comfortably mid-range, leaning slightly on the cheaper side compared to peers, but overvalued compared to the general market. When we look at all 3 ratios together, Alphabet's valuation shows a mixed but generally attractive picture. Cheaper than both historical and industry averages on PE, near the middle on PS, and slightly discounted on PB. If we add in a free cash flow yield of 2.71% based on approximately $66 billion free cash flow versus its approximately $2.3 trillion market cap and a PEG ratio of 2 based on my own DCF assumptions, and I'd give the overall price ratio score a solid good rating. Not a screaming bargain, but certainly reasonable for a business of this quality. Before moving on, let's introduce the 2 external sources we'll be using, Morningstar and TipRanks. Morningstar uses a DCF-based intrinsic value model, along with some of the industry's most respected fundamental analysis, while TipRanks instead aggregates 12-month price targets and ratings. I'll compare their numbers to my own analysis, so you can see how they align or differ. Morningstar rates Alphabet at 4 stars, with a fair value estimate of $237 a share. That's well above the current price of about $200, suggesting meaningful upside. They also assign Alphabet a wide economic moat, meaning strong long-term competitive advantages. and rate its capital allocation as exemplary. If you want my deeper thoughts on its economic moat, check out my earlier video where I break it down in detail. Here we can see Morningstar's fair value versus actual price over time. Alphabet has spent much of the past 5 years in undervalued territory, especially during market dips. Today's price to fair value ratio is 0.78, again pointing to upside potential. The business rating has consistently been high. As mentioned, TipRanks aggregates Wall Street analyst targets. Their average 12-month target is $216, implying a 7.5% upside from today's $201. That's less bullish than Morningstar's $237 fair value, but it still points to growth. The range spans from a low of $187 to a high of $240. So sentiment is generally positive. Looking at the most recent analyst actions, we see a mix of buys and holds. Bank of America targets $217. Citizens is more optimistic at $225, while Loop Capital and Wells Fargo sit lower at $190 and $187. Overall, the trend leans toward moderate upside expectations. So looking at all this, here's the big question. Are the analysts right? Today's share price is $201, while the average analyst target is $216. TipRanks rates Alphabet a moderate buy, with 26 out of 35 analysts recommending it. It's time to run my own valuation and see what the numbers say. But first, let's do a quick technical analysis. Alphabet's price has been riding a steady upward trend, respecting this long-term support line from before 2019. We've got clear resistance around $200 and support near $150. The chart suggests a possible pullback before another leg higher, so it might be smart to be patient and find a lower entry point. But if Alphabet breaks this resistance and all-time high, the stock might move upward already tomorrow. Here's how I calculate fair value using a discounted cash flow model. In short, it estimates today's value based on projected future cash flows, adjusted for the time value of money. I break it into 5 steps: revenue growth, free cash flow margin, terminal multiple, discounting each year's cash flow, and finally subtracting debt. You can pause here if you want to study the process in more detail. Time to look at the cash flow we'll be using for the DCF. Alphabet's trailing 12-month free cash flow is $66.7 billion, with a strong margin of 22%. Free cash flow is calculated as operating cash flow minus capital expenditures. In this case, $134 billion in operating cash flow, less $67 billion in capex. Over the last 5 years, free cash flow has grown at 9.27% annually, but only 3.6% over the past 3 years, so growth has clearly slowed. Management has guided for expenditures to remain elevated to fund AI and cloud growth, which may keep free cash flow yield muted in the near term. Now, let's plug in the numbers. Historically, revenue has grown at 15.27% annually, free cash flow at 9.27%, with an average margin of 22%, and a price to free cash flow multiple of 30 times free cash flow. In my normal case scenario, I'm projecting 9% revenue growth for the first 5 years, then 7% after that, with margins staying at 21 to 22%. I set the terminal multiple at 24, a bit below the historical price to free cash flow to be conservative. In the worst case, I drop growth to 6%, then 4%, with margins shrinking to 19% and a multiple of 19. In the best case, growth starts at 14% and eases to 12%, margins expand to 24 to 25%, and the multiple is 29. I've assigned probabilities of 50% to the normal case, 25% each to the best and worst. My discount rate here is the standard 10%. When weighted by probability, this gives me a projected revenue growth of 8.5%, a free cash flow growth of 10.4%, and margins just over 21%. All these scenarios are more cautious than the historical averages to build in a margin of safety. For context, Microsoft's current price to free cash flow is approximately 33 times and Meta's approximately 22 times, which helps justify my 19 to 29 times range across these cases. Here's the raw output from the DCF. Feel free to pause if you want to dig into the numbers, but personally, I prefer to see this in chart form to really visualize what's going on. In the worst case, using an average 5% revenue growth and 18% margins, I get a fair value of $111. That's a margin of safety of minus 45% and an annual return of just 1.88%. Revenue in this scenario grows from about $371 billion today to $604 billion in 10 years, while free cash flow rises from $66 billion to $103 billion, but margins stay flat. This assumes no meaningful operating leverage or margin expansion, essentially treating Alphabet as a mature company. Such a scenario might happen if regulatory actions bite hard, AI investments fail to monetize, or competitive pressure erodes ad and cloud pricing power. In the normal case, with an average of 8% revenue growth and 22% margins, I get a fair value of $199, which is just 1% below the current price, and an IRR of 9.1%. Revenue climbs to $801 billion in 10 years, with free cash flow at $176 billion. This outcome assumes Alphabet maintains its historical mid-20% return on capital and continues monetizing search, YouTube, and cloud at steady rates, without dramatic surprises on the upside or downside. In the best case, with 13% average revenue growth and 24% margins, fair value jumps to $380, giving an 89% margin of safety and a 16.9% IRR. Revenue here would more than triple to $1.26 trillion, with a free cash flow exceeding $315 billion. This scenario assumes sustained dominance in core search, while expanding into new monetization streams like AI-assisted productivity tools and enterprise cloud AI platforms. When we average the scenarios by probability, we land at a final fair value of $222, about 10% above today's price, with an expected IRR of 9.2%. That translates into a projected total return of 142%, or 1.42 times your money over the next 10 years. Price ratios still show Alphabet trading cheaper than both history and peers on PE and PB, which shows this might be the time to invest. The free cash flow yield is a healthy 2.71%, and the PEG ratio sits at a pretty okay 2.04. Overall, this isn't a screaming bargain, but for a high-quality business with a wide moat, it's reasonably valued and could make sense for long-term investors. Will the new AI direction push Google over $10 trillion? And with that in mind, is Alphabet a good investment today? If you've got thoughts on Alphabet's future, drop a comment below. I'd love to hear your take. And if you found this breakdown helpful, consider liking the video and subscribing for more in-depth stock analysis like this.